share, and here we go. Okay. All right, let's do it. Resident training. Woohoo! Okay. Volunteer tax consulting for U.S. people, U.S. tax residents. All right. So we're going to do intro to federal tax for residents. Then we're going to talk about filing status, and we're going to talk about dependents. All right, that is our goal for today. So as we start on this, the detailed agenda, let's talk about the training model, some more tax filing basics, and then, like I said, filing status and dependent. All right, so resident tax versus non-resident tax. They are very different. And as you can see from this, right? So I don't know if you can see online, but the 4011 that we have is like 35, 40 pages, which is the non-resident training guide. The 4012, which is the resident training guide, is something like 300 pages. So it is a huge, much larger amount of material, right? Whereas the non-resident is less material, but it is all very specialized and very unique. I already kind of mentioned this. As a resident, you're taxed on your worldwide income. Non-residents are only taxed on their US source income, the money they get from here. The big advantage that residents have is that the tax software is designed for them. There are built-in guides and assistants that make it work easily and properly and like lead you to the next thing, and is generally a good Crystal, I'll add you later. Thank you for that. The software will help you succeed at filing a tax return correctly as a resident. Now, there are generally issues as they update the software for the next year, which is what's going on right now. So if you went into the practice software right now, there would be mistakes. But in general, the software will help you do it right. And for the IRS test, we will use the software, always being careful of whatever those issues are as they update things. For non-resident returns, the tax software can be made to prepare returns for non-residents under most circumstances, but there are no built-in guides and assistance. So you are basically sort of fighting, sort of like working around the software to some degree. And occasionally you have to actually enter something that is incorrect to get a correct return out. So because of this, we do not use the tax software to train for the IRS test. We will fill out the forms by hand because it is much quicker and simpler and easier that way. We will focus on learning the tax software for non-residents in the spring. All right. There we go. All right. So again, for all of the modules for the IRS tests and for the tax clinics, right, reference materials are your friend, right, especially for the resident returns, right? Do not expect that you're going to be able to memorize everything unless you are also going to be taking your CPA exam while you're doing volunteering. Most likely you're not going to have it all in your head, and that is okay. You do not need to have it in your head. You can have it in the materials. So our training is focused on covering the materials that will help you pass the tests and be successful at the clinics. That means that we will spend a lot more time and practice on material that you will commonly see at the clinics, right? So the vast majority of our clients are students, scholars, teachers, researchers, staff at schools. So we're going to focus on things that would affect them, like scholarships. It's a big one. We're not going to focus as much on some of the things that are not common to see at our clinics, such as retirement income, Social Security, things like that. We will cover that at a higher level because that's required for the test. We want to make sure that you know how to find that information if needed. But if it's not seen in our clinics a lot, we will typically not spend an extensive amount of time practicing it. And then again, ask for help, right? I'm not going to give you the answers to the tests. I don't want to give you the answers to the clinic. I want to help you learn how to find the answers. And we want you to be successful, right? This program depends on the volunteers. So we want you to have a good experience, to learn what you need to do and what to know to be successful. All right. So let's talk about tax filing basic. All right. So taxes are an ongoing experiment in social engineering, right? We've had 100+ years of the government passing laws about who should pay how much taxes, right? This is both federal governments as well as state governments. Over time, various groups in the government have used taxes to encourage desired behavior. Get married, save some money on your taxes, have some kids, buy a home, go to college. All those things have been incentivized or de-incentivized. You can imagine a horrible layer cake of different groups changing the previous rules. I'm sure we will probably get some additional changes in the upcoming years based on the election results. That's okay, right? The taxes are what the taxes are. We're going to help people file them. But this has resulted in a very complicated tax system, right? That is why that book is so big, is because they have added so many rules to encourage so many different things. One of the results from this is that how much tax you owe is going to be very unique and dependent upon your personal situation. So it is very common, to have your return be different than somebody else, even if you think your return is the same. So let's talk about the general tax equation. All right, we start with income. Subtract adjustments, exemptions, and deductions to get taxable income. We take that times our tax rate to find our total tax. We subtract our credits, we subtract any withholding and estimated payments, and we find out if today is a good day or a bad day. Do we get a refund or do we owe money? So let's define those terms a little bit more, right? Income, very simply, right? Money coming into you. Adjustments will reduce your income based on money that you have spent or saved. If you spent it on the right thing based on what the tax rules are, you might get some money off of your taxes. An exemption reduces your income based on people. It is currently at a 0. However, the tax law that makes it 0 is currently set to expire in 2025. So who knows what will happen in the future? It may change, it may not, but for now, there's no money off taxes for people. That may change in the future. A deduction also reduces your income. The standard deduction will reduce your income by a set amount. Itemized deductions reduce your income based on money you've spent, right? If you spent it on these things and that's more than that standard deduction, then sure, you can take all that extra money off. That's all good. All right. The tax rate is the percent of your income that's paid in tax. The US tax system is progressive, right? So as you earn more money, you pay more tax on it. Credits will reduce the amount of tax you owe. Some of them will only reduce it down to 0. Those are called non-refundable credits. Other ones, they will actually give you money back. Those are refundable credits. Withholding is money that was taken out of your income and sent to the IRS or to a state or local tax authority. And this was done by the people that gave you that money. It is not done by you, right? They send it straight to the IRS. You never even saw it. However, if you know that you're going to owe money to the IRS, you can send them extra. It's called estimated payments. Usually this is often for people that have their own business. They know that they're going to have to pay tax. Other times it can actually be for our students, people with a taxable scholarship. So imagine a PhD student with a fellowship or an international student athlete that has $10,000, $15,000 of income, no tax taken out. They know they're going to owe a bunch. They say, here, take some of it now. I'll pay the rest when I file my taxes. All right. Who has to file a tax return? The IRS is very concerned about this. And it depends, right? the way a lot of the resident taxes work, right? Whether you have to file a return is based on your filing status, your income, and your age. Some people may not have to file a return, but they still may want to file a return if they have any taxes that were withheld, or if there's a tax credit that they could get and get some money back. Publication 4012 has the charts for that, but here is one of those charts where you can see filing status, and at the end of the year, what your age was, and if your income was at least this much, then you have to file a tax return. All right. You're going to want to download publication 4012. Make sure you have a copy of it available. You're going to use it when you take that advanced test. They have a very good table of contents that is clickable. So you can click on the who has to file a tax return, and it takes you right to this section. You can see all of that information. So it's very, very helpful to have that electronic version of it. So let's talk about what the different tax forms are. So Form 1040 is kind of the general tax form. It's the high-level form that everybody who files a tax return as a resident fills out. Schedule 1 adds additional income and adjustments. Generally, the ones we would see there would be taxable refunds. Otherwise, not a lot of common information on that for us. Schedule 2 is additional taxes. Those are usually on uncommon types of income, but occasionally we'll see retirement account withdrawals. This happens often when a student interns for a company. They get automatically signed up for their 401k. They're there for like 3 or 4 months. When they leave, because that internship is over, the company cashes them out of that retirement account and sends them a retirement income document for a small amount. Schedule 3 is additional credits and payments. Those are generally going to be for uncommon circumstances for us. We're not going to see very many of those. Schedule A is itemized deductions. Remember I said standard deduction is set amount, but if you spend more on these other things, then you can take those instead. Those things are medical and dental expenses, state and local income taxes paid, interest you paid on a home mortgage loan, charitable contributions, and some others. And all of these have some limitations on how much you can deduct. And it does get a little bit more complicated, but again, 4012 has a lot of that information. Beyond this, there are many, 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 many forms and schedules based on the type of income and or credits. The main thing to know here is that you're only going to include those schedules if they're used in the return. Otherwise, you're not going to include those, right? A general tax return is not a couple hundred pages. You know, it is usually easy ones are 2, 3, 4 pages. Something more complicated, you might hit like 6 or 7 pages. Not going to usually be that complicated and that intense. What does the tax return do? So taxes are done on a calendar year basis, and taxpayers are cash basis for any finance and accounting folks out there. This is not a legal requirement by law that they have to be a calendar year cash basis taxpayer, but the general way most people do it is that way. And it makes sense because all of our reporting systems like W-2s and such are based on that kind of calendar year cash basis reporting. For this coming year, for tax year 2024, it's going to be all income and all expenses from January 1st through December 31st, 2024. The returns are going to be due no later than April 15th, 2025. And days are always month, day, year convention. And I forgot to do this again. Dang it. Okay. All right. Sorry about that. All right. Sending in the form. So we will be e-filing forms for federal and state returns. So almost everybody should not need to mail their forms. There are a few circumstances where forms cannot be e-filed. Generally, it's when the person is married and their spouse does not have a social security number or ITIN. In that case, when they print out their forms from the software, they will have the address of where they need to send those forms. That is based on their address on their tax return. So Minnesota goes to Kansas City, Washington goes, I think, to like Ogden, Utah. Southern places go down to Texas, and I'm not entirely sure where the East Coast goes to, but there's like 6 or 7 of these taxpayer processing centers around the US. They all go to different places. All right, let's talk about filing status. So every tax return, every individual that's filing must indicate a filing status on their tax return. There are basically 5 options here. They can be single, head of household, they can be married filing jointly. We need to talk about if they're living together apart. Woo! Married filing separately or qualifying surviving spouse. You should note that anywhere where somebody else can claim a taxpayer as a dependent, so this filing status determines some of your minimum income for filing, right? If you are single, you have a different filing requirement than if you are married, filing separately, or married, filing jointly. Same thing for head of household and qualifying surviving spouse. So when I talk about like, hey, get married, have some money off your taxes, right? This is the first place we see that kind of in action. All right. The filing status determines the amount of the standard deduction. These are the amounts of the standard deduction. If you are over 65 years old, you get a higher standard deduction. If you are a blind individual, you also get a higher standard deduction. And if you are over 65 and blind, that's like the highest standard deduction you can get. We'll talk about this more on the tax return next year. But the other thing that you should know is the filing status does impact credits as well. So some credits are not available for married filing separate status. Some credits require a dependent, which we'll get to in a little bit further. All right, so how do we figure out what somebody's filing status is? All right, it's kind of a process of elimination. So taxpayers can file as single if they are unmarried on the last day of the calendar year. So unmarried means that they're either never married, they are divorced, so the legal document for their divorce is finalized and complete. They can be legally separated with a court decree, or they can be a surviving spouse, but they're not a qualified surviving spouse. And so unmarried is unmarried. And generally, there's not any choice about filing as single, right? If you meet one of these criteria, you have to file as a single individual. All right, so in a couple examples here. So Scott was divorced. It got finalized on December 30th, 2024. He has no dependents. What would his filing status be? And the answer is single, right? Because it's the last day of the calendar year. So you could get married and get divorced again, having started the year as unmarried and ending the year as unmarried. That is entirely possible. If his divorce had been finalized on January 1st, 2025, so just like 2 days later that he signed the paperwork, he would have to use a married filing status, either married filing jointly or married filing separately based on whatever he and his spouse decide. Because on that December 31st magic day, that's what his status is. All right. Head of household. So a taxpayer can file as head of household on the last day of the year if they are unmarried or considered unmarried, and they provide more than half of the cost of maintaining the house for themselves and a qualifying person who lives with them. So it's not just providing like childcare support, you're actually providing the support in the household to somebody that lives with them. So there are 3 tests for this one: marital status, housing, and a qualifying person. So think of it, you're not married, you're paying the bills, somebody else is living with you. And it does not have to be a child. It can be like a parent or something like that. All right. On the last day of the year, okay, a married taxpayer under some circumstances can also claim head of household status. They can only do that if they did not live with their spouse during the last 6 months of the tax year, and they meet the other 2 criteria, which were they pay for the house, more than half of the cost of the household, and they have that qualifying person, and that the qualifying person is their dependent child, stepchild, or eligible foster child. Gosh darn it. Thank you so much. All right. So for that housing cost, right? When we talk about the cost of keeping up a home, what falls into that? So that can be things like rent, fair market value or mortgage payments, real estate taxes, insurance on the homes, repairs, utilities, groceries. The qualifying person must have lived in that taxpayer's home for more than half of the year, so that's that 183 days. However, a dependent parent does not have to reside with the taxpayer. So in publication 4012, there are some good flowcharts about how to determine if somebody qualifies for that head of household status. So if you have a question on this, look at those flowcharts, walk through them to see, is that person gonna be eligible for that? So we'll do a couple of examples. So Jeremy was divorced, paid 100% for the cost of keeping up his own home. His son lives with him and he is the primary caregiver for his son. What would his filing status be? The answer is going to be head of household, right? Because he meets all the requirements. He is unmarried or considered unmarried. Thank you. Oh my gosh, I'm so sorry. Unmarried or considered unmarried. He pays for the costs more than the half of the cost of his house. And he has a dependent. He's paying the support for somebody that lives with them. Now, if we take that same example, but we say here, his son only lived with him for 3 months in the summer, he would have to file as single, right? Because he did not have somebody that lived with him for more than half a year for his dependent. And it's not one of the eligible dependents that don't have to live with you, which is the parent. All right, let's talk about married filing jointly. So if two taxpayers are married to each other on the last day of the year, they can choose to file a joint return together. It occasionally comes up. Doesn't matter like where the spouse is, right? If they're in a different country or not, if they are married, they are still married here in the United States. Just because they're in a different country does not mean that they're not married. That happens. That question gets asked sometimes. All right. If one of the spouses died during the tax year, that surviving spouse can file a joint return for that year. Someone whose spouse passes away after the end of the calendar year will typically file married filing jointly for that year. They can only do that married filing joint if they didn't remarry before the end of the year. So your spouse died in January, you don't remarry for the whole year, you can file a joint return with the spouse that died. Your spouse dies in January, you get married again in November, you can file a joint return with your new spouse, but you can't file a joint return with your spouse that died. That individual would be filing separate return. And it's important to note that taxpayers who are married filing joint, who do not live together, the filing threshold is very different. It is $5 rather than the standard deduction. So it is a big, much more likely to have to file separately or together. All right. Married filing separate, so people can choose to file a separate return. It can be beneficial on certain occasions. Generally, the tax law is kind of tilted towards married couples filing a joint return together. However, there are special rules so that they can file separately if you want to. Generally, it's going to be a higher tax rate. There are a lot of credits that you cannot claim for child and dependent care credits, earned income tax credits, education credits, and so on and so forth. So often it's going to be better for them to file jointly, but they do not have to do that. The other thing to know is that if they're filing separately, that filing threshold is $5. And then if one spouse itemizes, both spouses are required to itemize. Can't have one take the standard and one take the itemized deductions. They have to both take the itemized deductions. Oop. All right. All right, the final status is qualifying surviving spouse. So, married couple, the spouse dies. For the next 2 years, tax years after the spouse has died, a surviving spouse that has children may use this filing status, and as long as they don't remarry. And basically, it's an advantageous filing status to say you lost your spouse, you have a child that you're supporting, we will give you a higher standard deduction and let you claim some of those additional credits. So to be able to do this, you must have been entitled to file a joint return for the year that the spouse died. Even if you didn't file one, you just were able to do it. You didn't remarry, and your child, you can claim them as a dependent, or you would have been able to claim them as a dependent, except that the child had gross income over the threshold. The child filed a joint return, or the surviving spouse could be claimed as a dependent on somebody else's return. The child must also have lived in the home all year rather than the typical half year. So those are qualifying surviving spouse is not a common filing status that we will typically see at our tax clinics, right? Generally, a lot of the people we see are going to be single, but there are a good portion of people that are married. Occasionally, we'll get somebody that's a head of household, but qualifying surviving spouse is definitely not a very common one for us to see. Just knowing our population of students, scholars, so on and so forth. All right, so let's talk about the impact on the tax return. All right, so tax brackets are the main one, right? If you're single, it affects your tax brackets and your standard deduction. Head of household, you get a different tax bracket and a higher standard deduction. Married filing joint, you report your combined income. You get a single standard deduction that's big, and your tax bracket limits are generally twice the amounts of this single filer. So that can be really advantageous depending on how the two spouses' incomes come out. Married filing separate, each spouse files, which will put them in their own brackets. Generally, that could be higher, but maybe if one has very different income, that actually might be better. It also disqualifies them for a lot of the tax credits. And they cannot file if single if they don't qualify as unmarried. So again, right, doesn't matter where your spouse is. If you are married to them in your home country, you're still married to them here in the United States too. And then the qualifying surviving spouse, again, has the married filing joint brackets and standard deduction. So here's what those numbers look like. Again, you do not need to know these numbers off of the top of your head. Number one, you're always going to be able to look them up. Number two, it's going to be in the software, so we're not going to have to do all of that for us. But just for your information, here's kind of what those numbers look like. All right, so quick review. 5 statuses: single, head of household, married filing joint, married filing separately, qualifying surviving spouse. Some of those things require that you have a child. Sorry. Some of those things require that you be legally married or not legally married anymore, and it impacts your ability to claim some tax credits. Sometimes you can choose, like with married filing joint, married filing separately, and sometimes you cannot with single. All right, here are some additional resources on filing status. These links will be in the training materials, and the publication 4012 has some really good tables and flow charts. If you ever have a question, because there will be questions on the IRS test, and there will be questions in the Moodle. What is the best filing status for this individual? And that's the other thing to think about. When we do the tests, usually they'll say, what is their filing status? But really what they mean is, what is going to be most tax advantageous for that client to use as a filing status? All right. Any questions on filing status? All right. I know this is a little dry after all of the other tax stuff that we've done. Yes. It's hard to make filing status funny. I'll try. Okay, let's talk about a dependent, right? A dependent is a person other than the taxpayer or a spouse who entitles the person to claim a dependency exemption as defined by the IRS. You know, for 2024, they by law that exemption is $0. But having a dependent can affect other tax issues such as filing status, right? Head of household, qualifying surviving spouse. It can also affect your ability to claim some tax credits. A spouse is never going to be a dependent, all right? Even if they are here on a dependent visa for tax purposes, they are never going to be a dependent. We get that question a lot. All right. Dependents must pass a number of tests in order to qualify. And there are two kind of broad categories of dependents. A dependent can be either a qualifying child or a qualifying relative. All right, now remember, an exemption is something that reduces your income due to people. We did lots of adjustments based on how you spend your money. An exemption is based on people in your family. All right, so who qualifies as a dependent? There are basically 6 tests for a qualifying child. They have to have the appropriate relationship to you. So your child, stepchild, foster child, or a descendant of them, your sibling, half-sibling, step-sibling, or a descendant of them. You notice that it only goes down here. It does not go up for those relationships. For their age, they must be under age 19 at the end of the year and younger than you, or also your spouse if filing jointly. If they are a student, they must be under age 24 and a full-time student for 5 months out of the year at the end of the year. And then also, again, younger than you. Or they could be permanently and totally disabled at any time of the year. And at that point, age does not matter to be a dependent. They must be a resident of the US. They must be either a citizen, a resident alien, a national, or a resident of Canada or Mexico. They also must have lived with you for more than half of the year. There are exceptions for temporary absences or children that were born or died during the year or that were kidnapped or children of divorced or separated parents. On those temporary absences, so your child is considered to have lived with you during periods of time when one or both of you are exempt or temporarily absent due to special circumstances such as illness, education, business vacation, military service, and so on. The big one here is education, right? So for a lot of our customers, they are college students. So they are here getting educated. So they are temporarily absent from their parents' house. Generally, most of them have not truly like cut the cord and they're never going back and separated their entire household and become, you know, their own individuals. Some of them definitely have, but a lot of them have not. And so this would be one area in particular that we need to work with our resident clients on to make sure that they are choosing their right filing status, that they are or are not a dependent. And if they potentially are, that they are talking with their parents about who's putting them on their tax return. Because if they file on their own and their parents try to claim them as a dependent, it's going to completely mess up their parents' tax return. It's going to get rejected. And so a little conversation up front is going to go a long ways to hopefully keeping everybody in the family happy. All right, the next question or the next criteria is support. So to meet the criteria to be a qualifying child, the child can't have provided more than half of their own support. They can't file a joint return, and then whoever's claiming them must be entitled to claim them. And as you can imagine, right, very litigious US population, there is a whole list of, well, if this is the situation, then this person can claim them. And if this is a tie, then this is how we tie break that. If that is a tie, then this is how we tie break that. That's all in the 4012. I'm not going to go through it ad nauseum, but there is like a whole list of tiebreaker rules to figure out who is actually entitled to claim them or not. Yes.
So I have the question about support part.
Yes.
So, is there any like document kind of thing to like prove you're using half, like more than half of the money from your parents? Like, how do you prove it?
I mean, so the easiest way is to look at like your income, right? So you should have income documents. You work a job, you're going to have a W-2. You get a scholarship or fellowship, that'll get reported to you on a tax form as well, depending on your tax residency, right? And then you can look at your expenses, right? Okay, this is what your rent was. This is what your tuition and fees were. You know, you can estimate your food cost, your clothing cost, all of that. So there isn't like one particular form that you have to fill out that estimates that. But you can look at your income documents, which you have, and you can estimate your total expenses and say, okay, you know, am I getting more than half from my parents? Do I have a student loan, right? I would have loan documents that would support that, you know, to say whether you're supported or not. Yep. So this also affects some Minnesota property tax calculations as well for the dependency. So we'll talk about it more when that comes around too. All right. If you are not a qualifying child, you still could be a qualifying relative. And the first test for that is that you're not a qualifying child. So if you don't meet the qualifying child things, you may still be able to be a qualifying relative. This person must be a member of your household or have an appropriate relationship with you. So they could live with you all year, be related to you under one of the ways. I didn't include it here, but there's a list of people that don't have to live with you. Generally think like parents. And then if at any time that person was your spouse, that person cannot be a qualifying relative. Remember, a spouse is never a dependent, never a qualifying child or a qualifying relative. To be a qualifying relative, that person must also not have more than $5,050 of gross income. And the taxpayer must have provided more than half of that person's total support during the calendar year. And then again, there are more tiebreaker rules, links in the 4012 if you ever needed to go into that. Generally, we don't usually see, oh, why everything is jumping ahead. We don't usually see a lot of dependents in our tax clinics. We will sometimes, right? Teachers, researchers, they will bring their families, they will come here, they will have children and spouses, and we'll do all of this. But it is not a very large population of clients that we have that would meet one of these requirements. But when they do, being a resident, having dependents can make a really big impact on their tax return. All right, here is a summary table based on what this person is. I'm not going to go through it. I'm going to let you guys walk through, look at it again on your own. Again, if you have a question from the IRS on a test, or if you have a question in the Moodle thing, right? 4012 has all of this information. 4012 has some really good like flow charts to help you figure it out. Here's some of that additional detail. Oh, I know it's doing that. Okay. All right, let's talk about the impact of dependent, right? The primary impact is either enabling you to claim a filing status, like head of household or qualifying surviving spouse, or to help you claim credits. Child tax credit, up to $2,000 for every child that you have. Ooh, because that's so much less than what a child costs. But still, $2,000 is great. Education credits, up to $2,500, right? This is the big one where we start to get into the challenges with a college student that wants this refundable portion of the American Opportunity Credit, and the parent who wants the refundable and the non-refundable portion of the American Opportunity Credit. And so that's where ideally those two parties really need to have a discussion, pardon me, to make sure they understand who is eligible to be claimed as a dependent, how are they going to file? Because can make a big difference on both tax returns. All right, dependent review, really quick. Again, there are tests to meet either a qualifying child or a qualifying dependent. Basically, they need to be eligible to be claimed based on relationship, age, residency, support, and not filing a joint return. And then you need to be able to claim them as well. So it's kind of a handshake. Qualifying relatives, they can't be a qualifying child, and they've got to meet that household membership or relationship test, income test, and support test. There is also a super cool dependent calculator that can measure some inputs to help see if they are a dependent or not. TaxAid Colorado puts this tool out. So it is a good resource if you ever have a question when you're with the client. This is the place that we can help point them to figure that out as well. All right. And then a final couple words, right? This is quite complicated, really, especially for our clients, right? Because they're in this 19 to 24 range, they're students. We're going to start by doing that qualifying child test, right? Do they meet everything else? Education is generally a temporary absence. If they're not a qualifying child, are they a qualifying relative? From there, we can determine that child's requirements as well as that parent's requirements. Can they claim them as a dependent or not? All right. And with that, any questions about dependents? Any questions online? Okay. I didn't say that. I forgot to say it in the earlier thing. If you ever have a question, so you can email that volunteer@nrtaxhelp.org. That's a really easy way to ask whatever question you have, and I will generally always answer. I might first say something like, that's out of scope for VITA, but hey, this is the answer, just so you know, for your own knowledge. And with that, that is the end of our training today. Hooray. So same thing for Moodle. Once you do your volunteer data questionnaire, one of those questions is, do you want to do resident only or non-resident and resident? Once you give me that response, we will add you to the Moodle course for the resident training as well. Same reasons for why we do this. It's going to help you pass the test. It will help you be successful as a volunteer. Same skipping things as usual, same 80%, same things, right? If you do the non-resident and resident, there is a resident scenario as well that you have to pass in the volunteer readiness check. So that'll be 3 total scenarios that you have to do. All right. And you will have 2 modules to do. Amazingly, we talked about filing status independence, so you will get to try to figure out some best filing status and are these people eligible to be claimed as a dependent or who can claim them as a dependent? Because the IRS is very concerned about that. So that will be several questions on the test. So we're going to make sure that you guys have practice doing that as well. All right, with that, any final questions before we wrap it up? And we are in good time even, which is awesome. Okay, I am going to stop the sharing. I'm going to stop the recording. And where's the recording thing? If you do have any questions, I will stay